Welcome back. You're watching First Trades. Let's look at what's happening in the F&O market. To begin with, the spot market, 24,100 is where we are at this point in time, and that's led by financials and IT today. The IT pack up nearly 3.8%, and Nifty Bank up 1/5%. But there's a good contribution coming from some of the large cap banks there. But Nifty futures, if you look at, it's trading at a premium of 86 points. There's an unwind which is happening at this point in time. Some shorts getting covered for the Nifty futures there. In the Nifty Bank space as well, if you look at what's happening there, trading at a premium of 350 points to the spot. And again, there's some shorts getting covered in Nifty Bank as well. So both the indices, Nifty and Nifty Bank indices are up. If you look at what's happening in the Nifty Bank constituents, and there you see the entire play happening there. You have long build-up which is coming in for HDFC Bank, ICICI Bank. There is SBI which is also seeing some long build-up along with some long build-up in Bank of India and PNB. Kotak is seeing some short build-up. IndusInd, Axis and BOB are some of the banks where we are seeing some shorts getting built currently. With the Nifty Bank up nearly 113 points at this point in time. Look at what's happening in put and call writing. There's an aggressive put writing that has emerged in the last 1 hour of trade. You see that yesterday we saw towards the end of the trade that put writers were active there, but now you're seeing some put open interest build up happening in 24,000 and 24,100. There's an unwind of position happening for the July series for call. So the call writers are now pushing, taking up a position much higher in that sense. So the distribution will show you that there is some kind of support which is coming in for the market at 24,000 and 24,100. So that's what the distribution chart will tell you there. But there you go. The put writers having much higher open interest position in these two strikes at this point in time, and 24,200 is where there's an immediate resistance which is coming in for the market there. In the futures gainers, interesting stocks coming up there for you. Exide is seeing a long build-up, stock up 5%. Coforge and Emphasis, which got a drubbing in the last few days, are back with 5% up in the market, and long build-up seen there. In the losers front, you have stocks something like Avenue, which has been under pressure. The futures at 4,202, down 2.6%. BHL is down 2.5%, and GBTND. So capital markets and electrical plays are down in today's trade. So those are down nearly 2.5% in today's trade. The open interest gainers include Avenue, where we are seeing a 9% jump in open interest. KPIT Tech continues to add short positions today as well, and Exide has added nearly 7% in open interest as a result of a long build-up which is there. In the losers pack in open interest, we have stocks like Persistent, where there's a short covering happening. Tata Elxsi is seeing a short covering, and Wipro is seeing a short covering. We saw the stock getting hit in ADR yesterday, last evening in the US market. The stock seeing some short covering in the morning hours in India Open. But most active is the IT play today. Infosys 1,000 July call. There's an unwind of position which is happening. That's shorts getting unwind at this point in time. So you have 5.5 lakh contracts getting reduced today. The stock hovering around the 1,035 mark there. In the put side, you have TCS, which is most active. TCS 2,000 put, where we have seen 1.6 lakh contracts getting added in today's trade. The stock hovering around 2,041. The premium down nearly 33.75. So it's overall, if you look at the market, it's basically hovering around the 24,100 mark, trying to hold on to that level at this point in time, and and that's primarily led by the IT companies. But staying with IT, India's IT sector is headed for another soft quarter as deal closures remain delayed amid geopolitical uncertainty and rapid AI disruption. Brokerages expect muted Q1 growth, while management commentary on demand, deal wins, AI monetization, and FY27 guidance will be the key. monitorables in this quarter when the earnings comes out. Darshita has more details on what to look out for in the Q1 earnings for IT companies.
Right. The June quarter, meaning the Q1 FY27 earnings season for the IT sector is set to begin, but the street expectations looks fairly muted. Now, the brokerages have cut the estimate across the board, primarily due to the delay in the deal closure and the slower revenue conversions. While companies continue to win the larger deals, clients are taking longer to finalize the spending decisions amid the geopolitical uncertainty and the rapid evolution of AI. Even the signed deals are taking longer to ramp up. Adding to the caution, Accenture's latest earnings suggest that the weakness isn't restricted to one quarter and the softness appears to be extending into the second quarter as well, raising concerns over the near-term demand environment for the same. In fact, analysts now believe that FY27 could turn out to be the fourth consecutive year of subdued growth for the Indian IT sector. Now, Citi expects the top 5 IT companies to report the constant currency organic revenue growth in the range of -1.5 to +1% for the June quarter. Now, looking at the company guidance, Infosys has maintained its FY27 revenue growth guidance of 1.5 to 3.5% with an operating margin guidance of 20 to 22%, while indicating that the first half of the year should be stronger than the second. Now, moving on, HCL Tech continues to guide for 1 to 4% of the constant currency revenue growth for FY27 and an EBIT margin for coming in the range of 17.5 to 18.5%. On the other hand, Wipro has guided for -2 to flat sequential constant currency for the June quarter. Tech Mahindra has reiterated its target of achieving a 15% EBIT margin in FY27 but has refrained from issuing a formal revenue growth guidance, citing macro uncertainty and AI-led pricing pressures. Another key factor this quarter will be the impact of the annual wage hike, which could weigh on margins before offshore leverage and AI-led productivity benefits begin to offset the pressure. So what should the investors now track? Beyond quarterly numbers, management commentary will be critical, particularly on the demand trends, deal wins, and TCV, the pace of AI adoption, competitive intensity, and whether the rupee depreciation are providing any meaningful support to the margins. And those are the qualitative updates that are likely to drive the stock performance this quarter.
Thank you, Darshita, for that. So keep a watch out for the IT earnings starting next week. I think TCS is the first to come out with the earnings there. So we'll see what the commentary is with respect to deal size, AI monetization, and how they're able to maintain their margins in this environment. But moving on to Sai Parental. Sai Parental has strengthened its international business after its Australian subsidiary, Nomad Pharma, renewed an exclusive OTC medicines supply agreement with one of Australia's largest pharmacy chains. Meryl joins us with the details.
Yes, Sai Parentals is in focus today after its subsidiary has renewed a supply agreement. Now, the deal over here is valued at roughly AUD 202 million. That translates to a 1,300 crores and will run on for 7.5 years, starting the 1st of July, with an option to extend for an additional 3 years. Now, on an annualized basis, this translates to a 177 crore top-line opportunity for the company of recurring revenue. And what's noteworthy is that this isn't just a supply agreement renewal. This is also providing for 12 new over-the-counter products every single year, meaning that the size as well as the scope of the agreement will continue to expand over time. Now, under this partnership, the company's subsidiary will continue to be the exclusive supplier, meaning that they will manage the entire value chain, going from manufacturing and sourcing to compliance, quality assurance, warehousing, and even nationwide distribution in Australia. Now, for Sai Parentals, this offers significant long-term revenue visibility, and it will continue to support its manufacturing and utilization needs better, and even continue to improve its operational leverage. The company furthermore believes that the agreement strengthens its position in the international markets, Australia being a very regulated market and a very developed one as well. So it is only going to be enhancing Sai Parenterals' credentials and its reputation as a trusted pharma partner. From a valuation perspective, the company has a market cap of around 2,700 crores. So this deal is immediately a very big one for the company. And that is why we're seeing the positive traction in today's trade as well.
Thank you, Meryl, for that. The stock up 3.5% at 633 odd levels at this point in time. So it's tying up of future revenues with this deal for Sai Parental. But onto an ET Now exclusive. We have learned from our sources that the first GST Council meet after the massive GST rate cuts is likely to take place this month to discuss a host of issues. Kuldeep Singh joins us from Delhi with the details.
The GST Council is likely to hold its meeting this month. So this is what we have been hearing from our sources. And remember, this will be the first meeting after the September 2025 rate rationalization. Now, what we have been hearing from sources is that the Council may review the outcome of decisions taken in last year's meeting. And we must tell viewers here that the GST Council had simplified the GST regime during the last meeting. Apart from this, the Council may also discuss the issues related to inverted duty structure. Now, we must tell the viewers here that the idea occurs when the GST rate on inward supplies is higher than outward supplies. This actually results in accumulation of unutilized input tax credit, which ultimately blocks the flow of working capital to businesses. Now, the key sectors that have been affected because of this are manufacturing, pharmaceuticals, and FMCG. And the businesses have been raising this issue earlier also. Apart from this, the GST Council may also discuss and recommend the operationalization of Section 11A of the CGST Act. So remember, this act, this section was inserted in CGST Act in 2024, and it gives power to the centre to waive past GST liabilities. Now, important to note here is that the Supreme Court recently had upheld the retrospective operational imposing of GST at 28% on the gaming companies. Post that, what we have learned from sources is that some of the gaming companies had approached the government seeking waiver of the arrears. Now, the arrear here is somewhere over 1 lakh crore, and it will be difficult for the government to recover this arrear because a lot of these gaming companies have shut down their operations. Apart from this, what we have also been hearing is that the opposition ruled states may again raise the demand for compensation. Remember, in the last meeting also, the opposition ruled states had demanded that they should be compensated for their losses. Now, what we have been hearing from the sources from opposition ruled states like Punjab, Himachal, Karnataka, that these states, the finance ministers of these states are going to take up this issue again when the council meets. Recently, the Fitment Committee of the GST Council had met in New Delhi, and we must tell the viewers here that the agenda that has been approved by the Fitment Committee is being recommended to GST Council for discussion.
Okay, thanks Kuldeep for that update on GST meet. So it's a crucial one which is coming in just in time, and there's lots of issues there to discuss on that. On to another ET Now exclusive. IRDA Chairman Ajay Seth has outlined a series of reforms aimed at making India's insurance sector more transparent and customer-centric. Speaking on insurance awareness, Seth said, informed policyholders are the first line of protection against mis-selling. He also highlighted growing foreign investor interest after the 100% FDI and upcoming reforms in distribution and commission disclosures. Here's an excerpt from the interview that my colleague Anurag Shah did.
We do hear complaints of mis-selling, or not just a mis-selling, people suddenly surrender their policies or stop paying premium. As a system, we do not go to them and ask why did they surrender their policy? Was it a lack of income with them or some other reason? Somebody stopped paying premium. What was the reason? Go out to them and ask them, because it's an important part of learning and taking corrective measures. So this is one such area of reaching out to people who are not satisfied.
Okay, so will help in improving persistence here.
That's correct.
Yes, sir. So, under the reforms, Insurance Act amendment, and we have seen that 100% FDI is allowed. So, do you think that foreign insurers will have interest in Indian insurance sector? Because we have seen when FDI was raised to 49%, not much of interest, to 74%, hardly few players entered. So, with 100% FDI, how much hopeful that new entrants will enter in India's insurance sector?
There's a lot of interest. In fact, just about 2 months back, two new licenses were approved. In today's meeting of the authority, one more license was approved. It will come out in the release shortly. There have been requests, or rather we have already approved one of the foreign investor, rather a promoter, going up to 100%. Then there are a couple of other applications which are under consideration of the authority. So a lot of interest coming. More interested on the general, but recently one big player also has applied on to come into not as a green field but as a brown field in the life insurance sector as well. So it's showing a lot of interest.
A lot of companies will see in coming times.
That's correct.
Yes, sir. But sir, pie is not increasing. The overall insurance pie is not increasing. If we see by the penetration metrics also with the number of policies also. So is the regulator worried on that front? Because if pie is not increasing and more insurance players are entering into the insurance system, then there will be a competition, there will be a more and more commission structure, change in commission structure, more and more offering of commissions to acquire the business.
Are we worried? We are aware of the challenge and we are working with the industry to get those reforms in place which will enable the industry to grow at least 1.5 to 2x of the growth in the economy. And that creates place for everybody. But yes, this has been a challenging one, that we have top 4 or 5 players in both segments. In life, about 5 players, which are of decent size. In general insurance, maybe about 7 and 8. Other companies are unable to break out from the herd and then saying that because of the new business strategy, we are in a position to grow. So, sector growing at just about economic rate of growth is not good enough.
Not acceptable.
It has to be 1.5 to 2x.
Yes.
And that is possible with right kind of reforms. And again, Sabka Bima Sabka Raksha Act has clearly nudged us that we have to undertake that reforms without any delay.
Okay. But sir, going ahead, there will be some sort of stability because from last 5-6 years, we are seeing that a lot of changes in insurance sector, although the changes are beneficial for the policyholder. For example, in 21, we have seen the new tax regime. So there's no incentive for buying an insurance policy. In 22, we have seen the limit of 5 lakh rupees in life insurance. In 23, expenses of management rules were there. In 24, surrender value rules, which impacted life insurers. In 25, the 0% GST is impacted in the ITC. And 26, we're seeing the distribution reform. So going ahead, there will be some sort of stability.
I see it in a different perspective. Take the case of GST. Extremely important and a beneficial reforms, not just for the policyholders, but even for the sector players. Government signaled that insurance, health, as well as life, retail, for the individuals,
yes, sir.
No tax,
yes,
which
sir.
is akin to what the position on food items are.
Yes, sir.
So that has opened up huge amount of business opportunities. This is not saying that there is some embedded taxes there. It is a question of huge amount of business opportunities. Question of regulations around first year surrender. Why does the need for first year surrender arise? Because of the mis-selling. People who have bought the policy as a long-term policy today, surrendering it within a year, again, those who have got caught, they bought a product or they were sold a product which was not right. It was a signal that the first year high premiums should get moderated. So these are the measures which were taken for the further growth of the sector. So yes, it is the reforms or rather policy stability certainly, but in a growing sector, changes have to be nudged, changes have to be piloted and have to be guided. So it all will be through a extensive amount of consultation and then enough time being given for the industry to settle to the new requirements which may come in.
So that I said, sir, all these changes were beneficial for policyholders. Sir, we've seen that in economic survey and financial stability report, there were concerns were shown about the commission growth in insurance industry, particularly in life insurance industry. So how regulator is seeing the concern shown by Finance Ministry and RBI?
These are very much being addressed or sought to be addressed through the distribution reforms which are we are formulating, and I do expect, and I had mentioned it earlier, that we would come out, by this time we should have come out with a consultation paper. And there are several pieces in the distribution chain wherein the interest of policyholders, insurers, and distributors are not exactly aligned. At times they are in conflict with each other.
On ET Now, I am Snehi Shah. This is a show where we dive deeper into the broader end of the market, give you a better sense of what's happening. And at the index level, as of now, you've got about a 0.4% uptick coming in on the Nifty 50. We're above the 24,100 mark, at least for now. The broader end is also looking cheerful. In fact, the mid-cap end is in tandem with the Nifty, seeing gains of about 0.5%. The small-cap index is doing nominally better. You've got gains of 0.7% over there. So looking very good across the board, and the breadth of the market is also looking rather cheerful. Let's also take a look at some of the top buzzers from the broader end. And first up is Sai Parentals. The company is in focus after its Australian subsidiary Nomed Pharmaceuticals signed an exclusive 1,300 crore rupee OTC medicine supply agreement with one of Australia's leading pharmacy networks. The 7.5-year contract with an option to extend by another 3 years is a key positive for the company. And on the back of that, the stock is seeing gains of about 3%. Next up then, Texmaco Rail is in focus after securing 2 domestic orders worth 351 crore rupees for the manufacture and supply of freight wagons and railway rakes. The orders are to be executed up to October 2027, strengthening the company's order book and revenue visibility. Stock up 1.6%. The next big buzzer to talk about is ADF Foods. That one is in focus after its wholly owned subsidiary, the US subsidiary, that is ADF Foods USA Inc., received a $2.1 million, or if I translate that, that's 18 crore rupee refund from the US Customs and Border Protection. The refund relates to excess tariffs paid on imports. The stock is seeing some very good gains, very positive sentiment on the stock. That's up 9%. On the back of some Q1 updates that we've seen trickling in from the banking space last evening, J&K Bank reported a strong Q1 business update with gross advances rising 25.5% year-on-year, and deposits also grew roughly 17%, making it one of the strongest performers amongst peers. While CASA ratio moderated, the bank's overall business grew roughly 20.5%, reflecting healthy momentum. Stock is up about 3%. And then from the same group, you've got Tamil Nadu Mercantile Bank. That also reported its strongest sequential loan growth among banks that have so far at least announced Q1 business updates, with advances rising 7.5% sequentially and a total of 27% on a year-on-year basis, which is ahead of its own guidance. Deposits saw healthy growth too, and 2.5% higher is where the stock is right now. But yes, that's a roundup of all the top buzzers from the broader end of the market. We've got some notes from brokerages as well that are keeping some stocks abuzz. We're shifting focus to the corporate conversations that we've lined up for you on the show. First, let's take the conversation ahead with the management of GK Energy. We've got Mr. Gopal Kabra, the Mr. Gopal Kabra, the CMD of the company, joining us on the show. Mr. Kabra, hi, good morning. Good to be speaking with you. Let's talk about everything that's happening when it comes to the solar rooftop and solar pump space. We've seen a lot of government push also coming in. Before we talk about all of that, let's start by taking a look at how FY27 has begun to shape up for you. I remember earlier you had guided for over 3,000 crore rupee in revenue for FY27, and that was double of your FY26 number. 1 quarter down into this financial year, are you on track to achieve that? And what are the growth drivers shaping up to be like?
Happy to say that we are on track, as you mentioned. And the growth driver itself is the requirement towards the energy, global crisis, as well as the top leadership thought process to promote the renewable energy is the positive growth driver for this sector.
Okay, that sounds good. Mr. Kabra, how do you see the revenue mix between solar pumps and rooftop solar evolving over FY27? And which segment between the two will offer stronger, longer-term opportunity?
Both are going to remain the very strong for us. And definitely rooftop is a new beginning for us. So we are expecting around 25 to 30% of the top line should be from the rooftop.
Okay, so that's the number that you're seeing from the rooftop category, and you've also targeted roughly 1400 crore order book by the end of quarter 1 end when we had last spoken post quarter 4. Has that happened? Have you come closer to that number and any visibility on more orders in the offing?
Certain visibilities are there, so probably in coming days we should be able to announce that.
I understand that because of the quarter 1 just coming to an end, you can't give us an indication. But that 1400 crore number, are you in the ballpark? If you can't give us a clear number, I understand.
We will achieve what we have mentioned. I can say that.
Okay, sounds good. Okay, I won't push further on that note, Mr. Kabra. Your quarter 4 execution was impacted by raw material constraints. Have those challenges now been fully resolved, or are there any supply chain risks that you are still seeing on ground?
No, that has been resolved very well,
Okay.
perfectly, and the supply has been streamlined perfectly.
Okay, so that sounds good. And on that note, then, this margin number above 20% that you had locked in the previous year, confident of sustaining that for FY27?
Yeah, we are almost confident on that. I don't see much more variation.
Okay, so that also sounds really good. Mr. Kabra, you've also secured long-term DCR cell supply agreements. How strategically important are these tie-ups for the company in ensuring execution and margin protection ahead?
In a country we have 30 gigawatt of the solar cell, and out of that, close to 3% of the DCR cell, GK Energy being EPC company into the decentralized sector is having. So itself is a clear indication that strategically it's one of the major win what we have for the securing the raw material, and this is the why we are pretty sure that we will be able to achieve what we have mentioned.
Okay, so that sounds good. And the government schemes, such as PM Kusum and PM Surya Ghar, they continue to drive industry growth. How are you seeing the policy landscape evolving right now? What kind of tailwinds are you seeing from there? What does it mean for the company? And if you can also give us any visibility on if there are any more order wins in the works under these schemes.
Coming on the Surya Ghar, then definitely we have seen the May month and June month, which has been taken up from the government of India towards the solar. That has given the perfect results. And we are also looking towards a major shift of the domestic household user to implement the solar. And this will give the clear indication that yes, it is going to be a good year for the rooftop. And the policy drive towards a solar agriculture pump or the decentralized area of the PM Kusum, we are expecting it should become very soon, because the component B is the most successful in the PM Kusum segment, and that is a directly hitting the positively to the farmer, to the discom, to the environment, and that's why it's a complete win situation. So it is going to have the tailwind into very positive side towards the growth of this segment.
So that's where you're looking to capitalize on. Mr. Kabra, beyond the current order pipeline, where do you see the next leg of growth coming from? And also if you're looking to diversify into new products, geographies, or maybe new customer segments?
As we have already mentioned, right, we are looking towards the energy storage is going to be the new subject. Best what we are looking into it. And we are definitely in next financial year, we can see the major growth is coming in this segment from the BESS area.
Okay. And could you also quantify your renewable energy capacity installed? So far, it was at 276 megawatts, the last update that we had. After that, has there been any movement on that front, any targets that you've set for yourself internally?
Yeah, movement has been took place. The number I would be able to give with the results. So the good movement is there.
I understand. No worries about that. And, just slightly reiterating on the fact that you did say that 25 to 30% of your growth will come from solar rooftops. Am I right? Did I get that right?
Yes.
Yeah. So if you can talk to us about what geographies are you aiming for in that segment? And, we see that certain states in India already have very high penetration of solar rooftops, while certain states don't. What is your geography plan over there?
Right now, we have already geography where we are working is like Maharashtra and UP. These are the two major states we are aiming. Plus, MP is going to be the good business, I believe.
Okay, and lastly, Mr. Kabra, before we let you go, you were expecting an additional 700 crores in orders from the Magal-Tiala Phase 5 and Smart scheme. Any updates on that front?
Order is yet to receive. The procedure
Okay.
has been, so we are expecting soon.
Okay, sounds good. And maybe we'll interact with you once that order is in and keep this conversation going for next time. Thank you so much for your time today, Mr. Kabra. Good to be speaking with you.
Thank you.
Thank you so much. Okay, viewers, that was the management of GK Energy highlighting their FY27 plans. What really stands out from this conversation is the positivity coming in from the management that they are on track to achieve the 3,000 crore rupee revenue guidance that they had given last year for FY27. 1 quarter down, things are looking good and they are confident of holding on to the 20% margin for FY27 as well, and the order book is shaping up well. That sums up the conversation. On that note, time to slip into a very short break. Be right back with more on the other side. Back with Midcap Masala and throwing the spotlight on the primary market because we've got the newest kid on the block, CSM Tech, that has recently listed about a few minutes ago, and it has listed absolutely flat on the exchanges. The subscription, however, looked really strong. 1.37 times was the oversubscription that we've seen on the stock, with the retail category getting oversubscribed by 1.5 times. A little bit about the company before we interact with the management. It's a leading government tech and enterprise digital transformation company that provides customized software, digital platforms, consulting and IT services to governments, public sector entities as well as enterprises. So much to decode from that conversation in terms of what the plans are going to be now that the company is listed. We've got the MD and CEO of CSM Technologies, Mr. Priyadarshi Pani, joining us on the show. Mr. Pani, hi. First of all, big congratulations on the listing. Let's start by talking about the visibility that you have on your order book. Your order book is nearly twice the FY25 revenue. That's what I could draw from the numbers that I saw. If you can help us understand how will revenue growth shape up over the next 2 to 3 years, and also what kind of execution visibility do you have on the order book?
Thank you. Thank you for having me here. Excited, very happy for today. The company got listed in both the exchange. The company has good order books which is to be executed. Typically, our business, the contracts are executed in multiple years. Like we sign a contract this year, roughly around for 3 years, we have to serve the customer, or to 5 years. And then within that, there are a lot of scope of, implementation or upgradation or modernization of softwares that also happens within the contracts. We are looking forward, the orders in hand that we have will be implemented this year in FY27, FY28 and FY29. And we have a good funnel this year, which we will be, more deals will be signed and which also will be implemented in the coming years.
Okay, that sounds good. Mr. Pani, can you talk to us about the plan going ahead? Because historically, you've been a strong government tech player. Going forward, where do you see the biggest growth opportunities? Is it going to be within government digitization, enterprise clients, or are you also looking at expanding your scope in international markets?
See, we like agri-tech and fintech, we call ourselves as a GovTech company. As a GovTech company, the year-on-year spending spending by the governments around the world on digital public infrastructure has taken a different shape altogether. Each year we have announcements by the union governments or by various other governments around the world on investment and staying ahead in IT. Typically wherein the money to be implemented, money to be spent on digital public infrastructure. So this, like you have roads, you have railways, so is the DPI. And the investment into DPIs will create enormous amount of opportunities for companies like us. What we do in India, we are very focused on working on the GovTech. We work on several sectors like mining, agriculture, education. And we see the same replicability in various countries in Africa, Asian countries. Today we see a lot of opportunities coming out of various African countries like Ethiopia, Gabon, Mozambique, Malawi, and so on and so forth. So, and the spending there has been also increasing year on year. Including the United States of America and the Middle East, everywhere we're seeing a surge. COVID, for the reasons, unfortunately, IT sector, particularly in the governments, leapfrogged 4 to 5 years because of dire necessity in those days. And that is giving us a lot of benefit. There are a lot of modernization that is happening. A lot of new deals that are coming in the age of AI also, that we see a lot of new contracts coming in.
Okay, sounds good. Mr. Pani, how large is the opportunity pipeline when it comes to the government's digital transformation era? And you've spoken to us about that as well. Okay, I believe we've lost that feed, just taking you through what the conversation so far has been. And in fact, it's been an absolutely flat listing for CSM Technologies, listed at 113 rupees per share, which was exactly its issue price. And so far, the management has told us in terms of what the business model looks like. Remember, their order book stands somewhere around 350 crore rupees. The latest revenue number as of FY26, if I'm not wrong, was somewhere around 161 crore rupees. So the order book as of now is double the revenue that they're getting. So we spoke to the management about what is the visibility on the order book, revenue, and they did say that they're planning to sign more contracts at this year that will be executed all the way up to FY29. I believe we've got the management back with us. Mr. Pani, good to have you back. Let's talk about your financials. Revenue growth moderated in FY25 while margins stayed steady, and in fact they recovered as well. As growth accelerates going ahead, can we expect margins to remain at current levels or maybe even improve further?
See, in the past couple of years, we have invested heavily on the platforms, like I mentioned about the 7 platforms that the CSM has invested on. And we see a lot of replicability of those platforms in various markets in India and in Africa. Like, for example, what we have implemented in the state of Odisha, we get it replicated in the state of Chhattisgarh or in the state of Rajasthan, and so on and so forth. And not only there, not only in our country, but also in Kenya, in Rwanda. So these are the countries that we also see a replicability of the platforms. So while the company has invested in the past, we are expecting higher margins coming out from the deals that we are going to sign in from now on.
Okay, so that sounds good. And also let's talk about the fact that a large part of your IPO proceeds are earmarked for working capital and debt repayment. Can you talk to us about what the balance sheet strengthening is going to look like, and post this repayment, what the debt level is going to look like? What is the debt repayment timeline going to be?
See, while we work, there are debt repayments that will happen. Working capital funding is because we plan to invest on more skills, reskills. These are the plans that the company has. However, with some debt repayment, we will save some money that again will be used back in further profitability, further increasing the strength in R&D and and creating a pool strength. That is something that we have in plans. While we go forward on debt, for example, we have these bank guarantees that we have to give, for performance bank guarantees that needs to be given to various customers worldwide wherever we work. So they are for that the line of credit will continue, the line of debt will continue. So yeah, to that extent only.
Okay, understood. And lastly, Mr. Pani, beyond organic growth, are acquisitions likely to become a bigger part of your strategy going ahead? Are you also going to be considering inorganic opportunities?
Yes, that is for sure. That is something that we are looking forward to. And the discussions are on, and we will soon be informing you.
That sounds good. And on that note, Mr. Pani, thank you so much for taking the time out and speaking with us at ET Now. And also, once again, congratulations on the listing.
Thank you. Thank you. Thank you.
Thank you so much. So viewers, that was the management of CSM Technologies, newest kid on the block. We're shifting focus then and keeping it going with some more buzzers from the broader end. It's Sai Parenterals, big uptick at open, simmered down slightly from the day's highest point. Nonetheless, it's roughly a 3.25% uptick that we're seeing on the stock, on the back of the news flow that the company has strengthened its international business after its Australian subsidiary, Nomad Pharma, has renewed an exclusive OTC medicine supply agreement with one of Australia's largest pharmacy chains. Meryl is joining us with all the details.
Yes, Sai Parentals is in focus today after its subsidiary has renewed a supply agreement. Now, the deal over here is valued at roughly AUD 202 million. That translates to a 1,300 crores and will run on for 7.5 years, starting the 1st of July, with an option to extend for an additional 3 years. Now, on an annualized basis, this translates to a 177 crore top-line opportunity for the company of recurring revenue. And what's noteworthy is that this isn't just a supply agreement renewal. This is also providing for 12 new over-the-counter products every single year, meaning that the size as well as the scope of the agreement will continue to expand over time. Now, under this partnership, the company's subsidiary will continue to be the exclusive supplier, meaning that they will manage the entire value chain, going from manufacturing and sourcing to compliance, quality assurance, warehousing, and even nationwide distribution in Australia. Now, for Sai Parentals, this offers significant long-term revenue visibility, and it will continue to support its manufacturing and utilization needs better, and even continue to improve its operational leverage. The company furthermore believes that the agreement strengthens its position in the international markets, Australia being a very regulated market and a very developed one as well. So it is only going to be enhancing Sai Parenterals' credentials and its reputation as a trusted pharma partner. From a valuation perspective, the company has a market cap of around 2,700 crores. So this deal is immediately a very big one for the company. And that is why we're seeing the positive traction in today's trade as well.
Okay, understood, Meryl. Thanks so much for putting that into context for us. Shifting focus then, Jana Bank is in focus as the promoter entity. Jana Holdings gets a downgrade to default on the back of failure of repayment of bonds on due date. My colleague Anurag Joshi is joining us with all of those details.
The bonds of the founder firm of Jana Small Finance Bank have been downgraded to default at India Ratings following an extension for the repayment of the debt. Jana Holdings bonds have been downgraded to default after the promoter entity secured a 6-month extension to repay the bondholders. India Ratings, which has downgraded the notes to the D category, treats the repayment extension as a distressed debt exchange. Jana Holdings has to pay around 4,200 crore rupees of debt by December end after the repayment extension. TPG-backed Jana Holdings is unable to repay the debt on the original due date, and Jana Holdings had planned the repayment through a stake sale in Jana Small Finance Bank or through a refinancing of the debt. Jana Small Financing Bank, meanwhile, says that the promoter debt restructuring will have no impact on the bank's operations and no cross default linkage between Jana holding debt and Jana Small Finance Bank's borrowing is currently there. Jana Holdings is owning about 17% equity stake in Jana Small Finance Bank.
Okay, Anurag, thanks so much for taking us through all of those details. But with that, I'm afraid we're completely timed out on this edition of Midcap Masala. Thanks so much for tuning in. But keep watching ET Now, because Buy Now, Sell Now is up next.